Good morning, traders, and welcome to the Sydney trading floor. Right, so this is what I've been promising for a while. I'm just going to do a quick run through, and we've mentioned it for quite a while, on the difference in the markets and liquidity as we hit the holidays, and how best to trade it and sometimes to not trade it, because it can get a little bit whippy out there. So what I've done this morning is, just before I update all my charts, I've sort of left them as was, and it's probably a very good example of how markets trade during this time. And we're now on the 15th of December, so we've got 10 days to Christmas. We're well and truly into that holiday market now. I've sort of mentioned it a few times in a couple of the webinars that we've done. You do see liquidity removed from the market. Now, there's lots of guys going on holiday or thinking about going on holiday. Certainly most of the US banks, their end of year is the end of December. So guys are the big traders have either made their money or lost their cash, and they're keeping their cash, or they're trying to keep their jobs. And this all adds to a lack of, or a slowing of liquidity and a slowing of movement in the market, but it also gives like these horrible whippy moves. Now here's a great example of what we've been talking about over the last few sessions. This is the Aussie chart from this morning. I was just going to come in and update it and bring my downside trend line to here, but what you can see is a clear break of this trend line to the bottom, and then it comes back into the range, and you'll see this across the currencies for the next probably 2, maybe 3 weeks, until we get back into normal market conditions. Now I think that's normally the first, even the second week of January, once everyone's back from their holiday hangovers. What happens is, across the banks, guys start to leave only their stop losses orders out there, and their take profits are sort of and limit orders, as most of the retail market will know, are removed from the market. So when you get down to this trend line, yeah, it still slows, it's still relevant. You can see, bang, here it closed up, and we got a nice little stop loss run through. But once the impetus comes, the impetus is from those stop losses. You've then not got the whole market liquidity hitting it and bringing it. Normally you'd expect this move to at least extend down to, say, 71.20, 71 the figure, and a continuation of what's been a move down in the Aussie and up in the dollar. What's happened is the impetus is lost, and then it just moves back into the range. You'll see this in a number of currencies, and funny enough, you know, today I picked a good day for this. Here's the Kiwi, similar sort of position, funny enough, to the top side over bang, a little move through, took the stop losses out, and then dropped back into the range. Not massively, but it makes trading that much harder because it doesn't behave by the usual rules we're looking for. Here's cable. Now, funnily enough, there's a break to this top side trend line. Would have been a decent trade if you're managing your positions correctly, and this is what I'm going to come round to. And then look, it drops back into the range. So the way to trade these markets are to give yourself a bit more room. So say you're looking at this Aussie, normally we'd be sort of buying here maybe with a 25-point stop loss. You're out on your stop loss. But if you gave yourself 50 points, you're probably still safe, and then it drops back into the range, and bang, suddenly it's 100 points higher than the low, which is obviously what you want. When you're doing this, obviously what you want to do is reduce your trade size because you're making your stop losses bigger. What you also want to do is give yourself a little bit more room. So say you're putting a 50-point stop on it, you probably want to be looking for 150 points. Now, as I said, say you're buying just ahead of this level, just under 72 the figure, you're probably looking for a move back up towards the top of this range. Now, I'm not saying it hasn't come, but you know, you're back in the money and you can manage your position correctly. So this is exactly what we've got to look for in these markets. The other trade that works very well in these markets, for the reasons I've just highlighted, would be the false break. So here you've got a break and it's come back in false. So instead of buying here, you let the break occur, you keep that trend line in, and then you buy it here as it comes back through. Funny enough, you get in once again underneath 72 the figure, and it moves straight up for you, hardly retracing. So these are the sort of tactics you need to use in these markets. So 1, reduce your trade size, give yourself a little bit more room, and 2, look for false breaks and things like that. And it's for those reasons the market is pulling a lot of its liquidity because they're not as interested in trading. They've done their job already for the year. And also, you know, that whole thing that I was talking about, it comes down to that human side of things. Desks are getting reduced in size because people are taking holidays. That's why it's called the holiday market. So where you'd have normally like 4 or 5 big traders on the desk, you might now only have 2 or 3, and sometimes just the juniors. They don't throw as much liquidity into the pool. This translates not only from the banks but to the big guys as well. So the hedge funds, the real money, most of the real money guys, you would have hoped they've executed all their deals because they know liquidity things. So to execute any of their business, it's going to cost them a lot more money. This is what the whole market knows, and this is why we trade accordingly. So for me, in these markets, and let's just skip across to the euro, here's another one. I mean, euro has been a strange trade recently, but here's back to that ECB rate cut. And look, it's been sort of winding away. You know, to me, we're still waiting for the Fed. Now, the only thing that changes this year, apart from others, is there's such a massive reliance on what the Fed's going to do. We've been talking about it for probably over a year. We've been talking about a hike for certainly 6, maybe 9 months coming soon. Now, we're looking for this on Thursday. How much that's going to affect the market, I'm not too sure, to be honest. I think the majority of it's priced in. You may even see a dollar sell-off rather than a dollar buy, depending on what the Fed say after they hike, if indeed they do hike. But more importantly, at the moment, that's what we're looking for. And here's another move in the dollar yen. Dollar yen took out stops below the trend line and then back into the range. So think about that in holiday markets and trade accordingly. Got any questions on that? Always hit us up in the in our trade room, or send us an email, info@tradersfortraders.com. All right, guys, wish you the best. Good luck trading during the holiday markets. As I said, it is thinner. You have got to adjust your methodology, or not your methodology, but your parameters. Good luck out there, and have a great Christmas or whatever holiday you celebrate. Cheers.